Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Azul binti Jamhari from KBA 2424B. Today, I would like to present about Islamic finance and conventional finance. First, Islamic financial system. Financial system that operate according to Islamic law or Sharia and guided by Islamic economy. A core concept of Islam is that Allah is the owner of all wealth in the world and human are merely his trusters. Simply refer as interest-free as interest is completely prohibited in Islamic financial system. Islamic financial system is not limited to banking but cover insurance, capital formations, capital market and all type of financial intermediation. Next, conventional financial system. Conventional financial system operates on borrowing and lending money based on interest. It is profit-oriented and the major financial objective is to achieve maximization of the shareholder wealth through interest differently. Next, value proposition of Islamic finance. The advantage is it assigns in financial inclusions. The conventional banking system is based on paying interest at the predetermined rate on deposit of money. As both payment and receipt of interest is prohibited by the Sharia law, Muslims generally abstains from banking. Through Islamic banking, financial inclusion can be promoted and a large pool of saving can be brought into the economy. Next, the advantage is to promote the principle of financial justice. Conventional financing look forward to profits through interest payment and makes the benefit completely liable for any risk. Islamic financing pay way for the sharing of net profit or loss and the risk involved in a proportion manner between lender and the benefits. Next, the advantage is reducing the impact of harmful product and practice. Sharia principle provide any investment that will support industry that are considered harmful to a people and the society in general. The disadvantage is lack of uniformity of Sharia standard. The existence of different Sharia boards and different Sharia opinions promote inconsistent interpretation and application of Sharia rule. The lack of Sharia scholar of high standard is a major problem in Islamic finance. Next, the disadvantage is no interest. It's hard to claim some Islamic instrument as debts, therefore losing the tax benefit and increase the WACC. The disadvantage also is risk for depositor. The reduction of danger of insolvency is counterbalanced by increased risk for depositor. The profit and loss sharing model means depositor interest can fluctuate. Next, the advantage is encouraging stability in investment. In Islamic finance, investment are approached with a slower, insightful decision-making process when compared to conventional finance. Companies whose financial practice and operation are too risky are usually kept away by Islamic financing company. Next, the advantage is conventional mortgage loan is the equity build faster because of the higher down payment expected up front. Next, a plus to conventional loans that lender may be more willing to negotiate terms and conditions that with a government-backed loan where the lender must follow standard guidelines. In addition, a conventional loans on average is processed faster than a government-backed mortgage such as through FHA. The disadvantage is Islamic finance institutions have extra compliance, increased issue or transaction codes. Banks need to know more than usually, so more due diligence work is required. Next, Higher down payment makes it more difficult for some customers to obtain a conventional loan. If the borrower does not have a significant down payment, PMI will likely be required and the borrower must then meet the requirement of a mortgage insurance provider, which is essentially like applying twice for loan approval. Next, borrower may be required to pay a non-refundable fee at the time of applying for the loans, and if approves, the term of the conventional loan may include a stiff repayment penalty, meaning the borrower will be subject to this change charge if the loan is repaid early. Next, about structure and operational mechanism of Islamic finance system. Islamic banking structure. In Islamic banking, while income and pricing remain important, there is also considerations on why a product is launched and the impact it has on consumer. Not all fees can be charged and not all factors can be used in Islamic banking. The Islamic banking model itself is not a standalone arrangement. The most suitable application is the mudarabah. There is linkage between sources and application of fund, that is treasury, operation, legal, Sharia review and audit, and Sharia committed. Next, conventional banking structure. A conventional banking is designed to have two main functions, that is collect deposit and give loan. Under the conventional banking, the modus operation is shareholder give capital, bank receive customer deposit and invest, interest received are distributed, customer request for loans, bank borrow interbank funds, bank lends the fund at the interest rate, and lastly, customer pay interest and principal. Next, lastly, instrument offered by the different institutions and markets. Let's see, in Islamic finance, they have four, that is istisna, ijara, murabaha, and sukuk. In istisna, there is a payment that made by a buyer for goods to be delivered at a later date. Use the finance the construction period of a project. In ijara, a lease contract whereby a party is given a right of use in return for a rental payment and usually used for the operational base of a project financing in conjunction with a istisna structure during the construction phase. Murabaha is a credit sale agreement pursuant to which an agreed profit between a financier and a client is specific in a sale and purchase contracts. In conventional finance, they have four, which is line of credit, term loan, overdraft, and revolving credit arrangements. Line of credit is one way to reduce this transaction cost is use a line of credit. A line of credit is a regular separate loan for frequent borrower is a relative expensive means of doing business. Term loan is a straight loan, often unsecured, that are made for a fixed period of time, usually 90 days. They are attractive because they give corporate treasurer complete control over the timing of repayments. Overdraft is simply a line of a credit against which draft can be drawn up the specific maximum amounts. These overdraft lines often are extended and expanded year after year, thus providing in effect a form of medium-term financing. Lastly, in Islamic finance is sukuk. Sukuk is the Islamic equivalent of a bond rather than a debt claim the investor own a share in the underlying assets. In conventional finance, lastly is a revolving credit arrangement. Revolving credit arrangement is similar to a line of credit except That's not, the bank is legally committed to extend credit up to state maximum. That for all. Thank you.